Good morning, everybody. We'll be starting in about 5 minutes. Hello and welcome to the webinar. My name is Michelle Pierce and I will be producing today's webinar. To reduce background noise, we will start with all attendees on mute. However, questions and participation are encouraged. So if you have a question for Les, please post that in the Q&A. If you have any questions for me, you can also put that in the chat. A quick note about CPE credit. We are required to monitor attendance, and we do this by using pop-up attendance polls. There will be 3 random polls per hour, and in order to get full CPE credit, you'll need to answer 2 of the 3 polls. And I will leave those polls up for at least about 5 minutes at least. I will launch one of those polls now. So when you see that pop up, just respond to that poll. If you don't see that poll, probably means that your system might be blocking those pop-ups. So when I launch a poll, I will also put a note in the chat, and I'll do that right now. It looks like this. So if you didn't see the pop-up, you'll need to respond here in the chat. Then we can track your attendance that way. Other than that, just know that CPE certificates will be emailed to you within 3 business days. Les, over to you.
Sorry, I covered up my Zoom window somehow as I was doing the final things here. I've unmuted now. Oh, I see my video. I see my video, so I'm looking at myself. I think that should be fine.
I don't think your microphone is turned on.
We're working on Les's mic for a minute.
Do we need to get you new batteries?
No, I'm unmuted. I have batteries. Hang on.
Don't hear
Everything's, my settings are right. Are you not hearing me at all?
Earlier.
Melissa says she can hear just fine.
Oh. Can everybody hear Les? Oh, people can hear Les. I guess it's on our side.
Here's the truth of the matter. They have just muted me mentally. They have muted me. They're tired of listening to this all the time, so they've muted me. So everybody else can hear me. Okay, I'm gonna leave my door open. We usually have to close the door because we have all the feedback from all the different microphones because I have 2 people I have me speaking and 2 people monitoring my behavior. It takes that much effort to monitor this process. So anyway, we appreciate you being back. It's Monday. We don't know what's wrong here, but we're broadcasting, so that's good news. We don't like to have too many hiccups in the morning. Part 2 of our class today. Now, I guess they fixed it. My door is closed. So we're here for part 2 of this class. Now, we had a general conversation, about COVID last time, and then of course the Yellow Book. Now today we're going to still have a little conversation about COVID, but we're going to get there in a different way. And I think some of you, everybody should have if you signed up for the class, you should have got our email last week about some of the revenue recognition issues with regard to the specifically PPP money. Yeah, Kathy can't have more Diet Coke. I usually go get her one all the time. So anyway, we're sorry for that little hiccup. So today we're going to really talk a little bit about one or 2 gap issues. It's very unusual for us to address gap issues as we go through the class. Usually we're talking a lot about the HUD audit guide or compliance or all the things around which the compliance audit is driven. Today we are going to actually discuss about a couple of gap issues that really are the only gap issues we find significantly, or let me say consistently, in multifamily housing. With that, I think I need to now share everything. I'm going to share my screen. get rid of the general, and we'll get going. I do have the Q&A open. I do have the chat open, so we're really looking forward to any comments you might have. It's very useful just to hear that you can hear me. But if you have other questions along the way, today we will get a little bit more into certainly HUD and the audit guide. We will talk briefly about rural housing and any changes we know about there. I mean, this is an update course, so we try to focus more on things that are changing or specific areas that might require additional audit coverage or things like that. So that's why we're picking these topics today. From an accounting rules perspective, this conversation is going to focus on in really two areas, maybe three, but we will talk a little bit about single audit also through here. We will not do much on single audit. We're having a separate HUD-oriented single audit class, which will address most of the specifics of auditing HUD in the single audit environment. Now, of course, there are only 3 compliance supplements for multifamily. That would be a 202, 811, or a Section 8. So the majority of multifamily housing now that's performed by nonprofits is now falling under the HUD audit guide. It's still single audit, but there are no compliance supplements for that, and we're back to the HUD audit guide. So our single audit class will address more of the nuts and bolts about making that conversion from a normal single audit environment to a HUD guaranteed loan environment, so where there is no compliance supplement. Okay, having said that, today's GAAP conversation, nonprofit entities. We needed to revisit ASC 2018-8. That has, it's I guess almost serendipitous that it came out when it did. So we went through last year and we've had some conversation about 202s and 811s in the marketplace over the last 6 months. I've had 7 to 10 emails around accounting for 202 811s in relation to topic 958. Well, we should say 958605, revenue recognition. And strangely enough, here we get into it where a few people are impacted last year, and now we come into this year and we might find 60 to 70% of the people impacted by this straight away, just simply through PPP loans. So I guess it paid dividends to bring this back. And then just a little bit on debt modification and extinguishment. This is really a planning work paper disclosure problem. Most peer reviewers do not get overly excited, per se, about GAAP challenges. I don't know that they're paying as much attention to that as they are, say, if you're really worried about independence, and that's the focus about who prepares the financial statements. We turn around then and end up with maybe less focus on in a couple of other areas. One of those is being the GAAP side of this. And so we don't usually get too caught up in GAAP problems, but we do have a few. Then we'll just talk a little bit about insurance. I'm even having an insurance problem right now at one of the projects I'm associated with. We're having a little bit of an argument about what to do with insurance. And then last, we'll just talk a little bit about single audit. And then briefly, I know we did this kind of already, a little bit about internal control. We're going to do that in 2 pieces. So on to 2018-08, contributions received. This is the standard we're looking at now. We implemented this as part of a revenue recognition suite last year with topic 606 coming into play. Multifamily housing had to address the impacts of revenue recognition. luckily, but maybe people don't agree with me. I think it's luckily we don't have too much to deal with 606. We're specifically exempted in most of the multifamily area due to leases. The other side of that was the grant topic, and that came out last year, and we found out that really only about, less than 5% of all revenues have any relation to topic 606. So we're exempted due to leases, we're exempted due to other things. And then as a for-profit side, we don't get as many grants as we do loans, but on the nonprofit side, we have the 202-811s and other grant money from either home funds or CDBG grants or other currently CARES Act money. And we have to look at that. But very, very few things were subject to 606. That might be, parking charges or lockout charges, all those other things. So anyway, it's a very, very small amount of money. But topic 958 is a very big deal, especially in the nonprofit side, but it's turning out to be impactful even on the for-profit side. And we went through this, and our conversation ultimately was just about a couple of really straightforward things. Is the money we receive an exchange or a contribution? Well, we wanted to drive that home now in case, but we need to remember one thing. This does apply to all entities. It's not just nonprofits. It applies to all entities. However, it does exclude transfers of assets from the government to business entities. Now, the standard really breaks out possible impacts into two areas, not-for-profits and business entities. So business entities are considered the for-profit side. So we know in case of PPP money, that is a transfer of assets from the government, we hope ultimately, from the government down to the project. But 958 does not specifically apply there. But it does apply to both contributions received and contributions made by providers. And of course, we're not really a provider. We are always a recipient, and so that's the good news here. And we don't really care how you label something. It's really about what the intention of this transaction is. So what the source or the revenue, what the documents say, drives the accounting, not somebody's labeling. It's in place now, has been in place. It came in for 12/31/19 year ends. So fiscal years beginning after year end, are 12/15/2018. So we were in place for last year. Now, the number one question that came up in May, June, July, especially driving out the deadlines that far on the nonprofit side, what has to happen with my 202 or 811? And if I had money inside a 202 811 and I had recognized the revenue and it's sitting in net assets, is that okay? And the answer was yes, that is okay, because the standard didn't require us to revisit or redo anything. We did not have to de-recognize revenue. That's the phrase the standard uses, is de-recognition, okay? So whatever we had done with our 202 811s in the past, especially if we had recognized the revenue, we did not have to de-recognize revenue. We were good to say, look at it on a prospective basis. However, if we have the money sitting in a loan, then we will be driven to recognize revenue under the new standard. So whatever is unrecognized now has to be recognized in accordance with this standard. Now, there's a little bit of a confusion, I think, between 958 and IAS 20. You're going to see here in a minute some people reaching over to IAS 20 to get guidance on how to record PPP loans. And there is a difference between what we're doing in GAAP, in the US GAAP versus international standards GAAP. And we'll talk about that in just a minute. But topic, well, ASC 2018-08 is analogous to essentially IAS 20, with some significant smaller differences. So we didn't have to unbook anything we had previously done. There are quite a few conversations that were being addressed, such as, I took this audit over from somebody else, here's what they did, is it right, is it wrong? If they had put it in net assets, should it then be restricted net assets or should it be unrestricted net assets? And those questions are still in place, but I did have one person who is sitting on a report trying to find a way to actually recognize revenue correctly that fits what the client needs, because if they recognize revenue according to 958, they are going to not meet any of their debt covenant requirements now. The debt covenants were written in such a way that did not anticipate a change in revenue recognition. And you know, we maybe talk about that a little later. So prospective transition method, everything, you know, nothing that had been done had to be undone. And we're down to the first thing. And our first step is deciding if a thing is an exchange or a contribution. In all conversations, this is step one. Now, we recognized last year that any money coming from a third-party payer on behalf of an identified person, such as a tenant, is an exchange transaction, whether it meets the criteria for it or not. Section 8 is the specific example here. Now, the standard actually used the Medicare-Medicaid example because it's a little more pervasive than, say, Section 8 on the housing side. But that tells us that we identified subsidy. The government is actually paying the rent for less sparks. I'm not giving you the money and say, look, I gave you enough money to pay for 100 tenants. We are giving the money for less sparks, for Michelle, for Kathy, whoever that is identified. That is a specifically identified person. So even for the profit-motivated side, the destination or revenue recognition of this said it's an exchange transaction. All we just did then was said, well, it's not really subject to 606 because our exchange transaction is a result of a lease. And so therefore, we are under the lease standard, not 606. And the majority of our revenue was excluded from 606. But Section 8 money is always identified, well, let's put it this way. Section 8 money, we had a class, last week's class, we talked about getting COVID supplemental payments, and then we talked about, and that would be the $200 million, and we talked about CARES Act putting in about $800 million into Section 8. Any Section 8 money that comes out of the $800 million will be an exchange transaction, because any money we hand out of that $800 million will go to a specific person. It will pay for subsidy. The only thing we're anticipating is that the subsidy may be higher than it would have been in a normal year because people are out of work. But it was still subsidy. However, the COVID supplemental payment goes to the project, but it will not be identified to a specific tenant. So that money will be a contribution. And you'll have to decide about whether or not it is conditional or not. And in fact, I think it is conditional because you had to incur a certain amount of money. In fact, to get the money, you had to show that the condition was already met. Well, tier 2 money, the big money, the bigger source of money, you had to prove that you had already spent the money. So in theory, if you get awarded that money, any criteria that would go along with it should have been the expenditure of the related expenses, so we should have already qualified for the revenue when we get it, which means we would have met the, and I don't know if it came with a specific right of return, but anyway, because I haven't seen the agreement, the COVID supplemental payment agreement. I know the money's out there, people are now responding to us, but now we clarify a little bit about what is a third party, the general public, and you know, benefits to the general public are, you know, those are non-exchange transactions that go to the general public. If the primary beneficiary is a third party, use judgment, that's fine. And we could go through the size of the grants. I don't really, the grants I think are just, these were examples from last year, and I think everybody kind of understands it, but I think the one on 14, slide 14, that is more interesting was just this issue of job training to low-income residents. The state used to do it. Now they're saying, I'm giving the money to a nonprofit and telling them to do it. So the state used to do this. Is this going to be an exchange or a contribution? And the answer is, generally, it looks like the general public is the beneficiary here. And so that would tell me it was a specific, it was a contribution. However, if the state required the identification or qualification of individuals before they got the money, so that when the state had the money, they know they're paying for Les Sparks's job training program, then it would have been an exchange. So you would have to really then pay attention. Now, if you have an exchange transaction, so you went to step one. Step one, determine, is it exchange or contribution? One or the other. One of those two things it has to be. Step two, if it is an exchange transaction, apply 606. And if 606 did not apply, then you know that you can go ahead and apply leases or something else, like we're doing in multifamily currently. However, if you determined it was a condition, then step three would be apply or determine if there is a condition, because we've determined one, it's a contribution. So to reiterate, step one, determine if exchange or contribution. Step two, if exchange, apply 606. Step three, if not, determine it, so it's a contribution, and then determine if there's a condition. Okay? Now the condition, to keep this as simple as possible, it's conditional if both of the following things are met. Did you or did you not have a right of return or a release specifically stated in the agreement? Yes or no? If you did not, then it is not a conditional contribution. If you did, it is a conditional contribution. Now, the classic example is the 202. If you run it right, here you get $10 million, right? $10 million comes to you. You build a building, and you are told that if you'll run it right for the next 40 years, we will forgive the loan. But there is no annual forgiveness. So we do know it's actually comes out in a mortgage note. So everybody who has this has a regulatory agreement. They have a mortgage note. It just does not bear interest, and it is essentially forgiven at the end of year 40 if the building stays in use for its intended purpose. So that's a classic example. In the meantime, there are barriers because it comes with a subsidy contract which requires that the owner or agent verify each year that the tenants qualify for the subsidy that is available. That constitutes the barrier. Now, the barrier or the right of return doesn't go away ratably over time. You don't get 1/40th of it back. Now, what this means for the future, well, we'll continue on a little bit. So we do have the right of return. And then it said it must also include a barrier. So both things have to be met. So you must have an explicit right of return. PPP money is certainly meets those requirements. It comes out as a loan from the SBA. And the barrier is you have to employ certain persons in order to qualify for forgiveness of the loan. You had to meet criteria. So you had to be under 500 people at that size, you not meeting the affiliate rules, a couple of other challenges with regard to that. And so PPP money represents a conditional contribution because it has a right of return and it has a barrier, just like a Section 202-811 PRAC does. So once we establish that, we know the right of return is explicit. It's part of the agreement. And then we go to the barrier side. These are pretty simple in most of the examples we have today. So it has to be something that's performance related. Performance meaning what's the purpose of the agreement and how do we monitor our progress in maintaining or meeting the purpose of the agreement. So the stipulation or the requirements limits our discretion on what we can do. We can't we can't lease a 202-811 to any person who just wants to show up and live there. They have to meet specific criteria. And that stipulation is exactly related to the purpose of the agreement. Same with the PPP money. It was to keep people employed. So we will have to address that in the PPP loan world. Now there's a little bit more involved with that, but that's okay. We'll have to deal with that as we move along in that regard. So it has to be something measurable. Okay, so how many meals, how many people did you employ? That was a pretty easy one. How much subsidy was handed out to people that were qualifying individuals? Were there matching contributions or something like that? Now, the limited discretion on the conduct and activity barrier, something that says requirement to incur only qualifying expenses that are based on requirements, or hire specific individuals or protocols that you could deal with that. But things that are trivial or administrative are not. So if you said, look, you got to file financial statements, that will not be a barrier. Reports showing how you spent money are not barriers. Now, what that means to each of us is we go to PPP. Now we're kind of to the end of this discussion on what the gap requires. So let's just assess PPP money. Now, in our email we sent out the other day, there are specific amounts of challenges to how to deal with PPP money. The first one of those, and I didn't put this into slides, but let's go into, I'll go back to, well, I can't open my email here because I've actually had to close my email so it doesn't beep during the day. But if I just go to AHA CPA, oh, sorry, that was the wrong one. Kathy, where was the one? Oh, maybe she hasn't posted it yet. I guess it hasn't been posted. It came out on, what, Thursday or Friday. And it mentions a couple of things here. I guess I will have to open my email. The challenges I wanted to discuss are really not that significant in terms of the overall thing. The decision process for this is what is significant. Sorry. AHA. I'm very sorry to take a second here to make that happen. And I apparently can't make it bigger. Okay, some of this was just the decision. So the first question of this is, where did the money go? Right? Where did the PPP money go? Did it go to the management company or did it go to the project? If you are a nonprofit, it could have gone either way. Most for-profits would have applied for the money at the management company. That's where the employees legally belong. And this raises a bit of a challenge. Then, of course, I mentioned number two, if it resulted in surplus cash, what should we do with that? Does the loan mean the project is being paid twice if they have subsidy? And how should the forgiveness be accounted for? The one we're really asking about here is the forgiveness, by the way, that we're answering, here. Now, other people have had these similar problems. I think in the materials today, I have another document put out by a larger firm for their, just an accounting decision thing. I mean, they said I could, I could use this. I blocked out the amount because some of the amounts, some of that's public, you could tell who their client was. But so they got a hold of this client. And now the problem is they're figuring out, the management company went and got the PPP loan. They did it at the management company level. And of course, they were going to spread the proceeds among the many properties it manages, which were HUD, non-HUD, subsidized, market rate, some assisted living, but it has more than 500 employees. So they were curious about, they were relying on the affiliation rules, and they know that PPP loans over $2 million will be subject to audit. Now, for most of us, PPP loans under 150 will probably be automatically forgiven. So we don't really bear much concern about that. But when they're looking at what happened to this entity, they're not sure. So here was the goal. They decided they would push it down. Now that decision is not final or done by everybody. Many people are not going to push the money down to the project level. And Brandon, no, we do not have a regulation. Let me say it this way, Brandon. What we're going to get down to is that the gap is a bigger issue right now than the disclosure on the loan. The disclosure on the loan is really going to be about what we do with the money and how you recognize revenue. Second of all, where is the money going to sit? If you got it at the management company level, and this is really why we brought up this topic about revenue recognition, you can see here on this discussion for properties that make up the portfolio, they were going to record the amount in accordance with what we're discussing now, 958605. And that makes it a conditional contribution. Their problem at this stage is they do not think the property is going to, or the agency is going to meet the requirements for forgiveness. Therefore, they cannot record the revenue because of this attribution rule. So they were looking for the proposed treatments to debit salary, expense, and credit accrued wages payable for salaries incurred but yet not yet paid. So they're giving us the HUD accounts they were going to do. So they were going to debit repairs and maintenance or administrative expense and credit 2120 accrued wages payable. And then, of course, ultimately, with forgiveness being achieved, the payable would be forgiven. And that means they're basically shoving the grant money down to each project. Other management companies are not doing that. So, Brandon, let me just say it this way. What's the first thing you really have to decide is where the money is going to go? What's going to happen with the money? Then you can decide what happens with the money. Now, you know that it's a loan. So right now, somebody debited cash and they credited a liability. Now, that brought up several problems that we'll discuss. But the first one is what to do with the money once it came. Now, if I'm an owner and I run the management company and I have ownership interest in all the items all the projects the management company manages, I would keep the money at the management company and I would not shove it down to the projects. After all, the management company took all the risk on the employees. If they couldn't get paid by the projects for whatever reason, the management company was out on the salary, and that is the argument for keeping it at the management company. If that is the case, then you would recognize revenue according to the model you desire at the time you meet the model's requirements. If you're going to shove it down to the projects, however, now you still have to decide when to recognize revenue. Oh, I didn't mean to do that, sorry. And I wish I could make that bigger, but I cannot. Now, if you actually got the loan at the project level, you are running another problem, and that was the problem down here I mentioned about Q&A from last week, the HUD Q&A. And that's question number 19. It's in a different section though, so hang on a second here. I can't do that. Wouldn't you like it if it just did it all at once and it didn't have it all in separate, how many 19s there could be? I can't grab that right now, but oh, it's question 2, sorry. The problem here is if the project level, did you get HUD approval? If you had a mortgage, if you had a HUD insured mortgage, you had to go to HUD to get permission to lend or to borrow money on another loan that would put you or violate the subordinate financing rules. We've already had 2 or 3 projects. I think these were 202s that got PPP money and have already been told they're in non-compliance due to not getting HUD approval before they got the PPP loan. So that's the next problem here. If you went to the project, did you have a mortgage, a HUD insured mortgage? If the answer was yes, you're in violation of the subordinate financing rules, and that's what question 2 is addressing. Then if you did push the money down to the project, when will you recognize revenue? Now, the AICPA put out guidance on this. It keeps opening in another window. This is in your materials today. So depending on where you are, they're going to talk about accounting for this. And Brandon, this is specifically getting to your question. I don't know that there is anything particular about the PPP money that needs to be disclosed per its agreement. What you do have to do, though, is disclose how you're accounting for it and what the revenue recognition for it is, and whether or not, I guess, you believe you were going to achieve forgiveness criteria, meet the criteria for forgiveness. So at the very least, the AICPA has issued authoritative, this is out of Q&A section 32. They issued non-authoritative guidance earlier in April or May. This was in July, and it's authoritative guidance. So how should we account for the forgivable loan under the small business protection? You really have three choices to do this. You can go to 470 on debt. Okay, you can go to IAS 20, accounting for government grants and disclosure of government assistance. And then ultimately you can go to 958. So if you're going to 470, they give you this. You would say financial liability and accrue interest in accordance with the interest method, and then he would not impute additional interest at a market rate, even though the stated rate may be below market, because transactions where rates are prescribed by government are excluded from the scope of imputing interest. Then when you want to derecognize it, you would go to gain contingencies out of ASC 405. And under there, the proceeds of the loan would remain recorded as a liability to either the loan is in part or wholly forgiven and the debtor has been legally released, or the debtor pays off the loan. So there you would not be able to remove the loan until you receive forgiveness. Now, if you are a non-governmental entity that is a for-profit or is not a not-for-profit, this is why they get to this. Why didn't they just say it's a business entity, which they do in parentheses, and you expect to meet the eligibility criteria, then you can use the IAS 20 outline model. And this one comes up with two criteria. Conditions attached will be met and the assistance will be received. Well, you have the cash. Okay, Maggie, I see, sorry, the chat came up. What happens if the PPP loan is forgiven by year end and they did not seek permission for the loan? Is it still a violation? Forgiveness is assumed or achieved, right? I get that. HUD's position is that it technically, this goes right back to the audit guide, Maggie. If a thing was wrong during the year, but they correct it before the end of the year or before the report is issued, it is still a finding. Now, I know for most of us, we took PPP loans with the intent of having forgiveness. Nobody actually believed, frankly, they didn't believe they were borrowing money. So what we do know already is that people are accusing projects of violating the regulatory agreements. That's what we know HUD is doing currently. However, if, in my opinion, and this is just opinion, so Maggie, take this for what it's worth. Based on what I'm seeing so far, it would be a finding. Now, if the loan has been forgiven and we have met the criteria, officially or even just by our own determination, okay, I don't know that you'll find anybody actually getting forgiveness by December 31. The way we're looking at this now, they had 64,000 loan packages had been received on the forgiveness window, and I don't think they have processed any of them as of a week ago. So whether they get to actual processing is a whole other world away. But let's say we believe we've met the requirement, so we're going to recognize the revenue. This condition has now been remedied, so to me it would be a finding with a corrective action already achieved. In other words, they have got rid of the loan, and that should be a no harm, no foul. But HUD is taking the position that loans obtained, PPP loans obtained without HUD permission were technical violations. Well, I can't say that we're seeing it everywhere. We have seen it done already. Some places are doing it. So in the concept, if you went to the very basic concepts of the HUD audit guide, they would say if a thing was wrong and it got corrected before year end, it was still a finding. It's just a corrected finding. Now, whether everybody's going to do that or not is up in the air. I put out in our email Thursday that I thought it would be a violation, a technical violation of the agreement. Okay, sorry, that's a little bit of a outside from where we were talking. So IAS 20 would allow that to happen when you say the conditions were met and the assistance was received. Well, you already had the cash, so the only question is, did you meet the conditions for a forgiveness? Well, if that's the case, you could recognize the revenue. If you believe you have met the conditions for forgiveness, you would recognize the revenue. Now, it said also, if a non-governmental entity that is not a not-for-profit, that is, again, a business entity, expects to meet the eligibility criteria and concludes it represents a grant that is expected forgiven, the staff observes it can analogize to ASC 958605. And by the way, both of these would have to be analogizing. So if you go to 20, you have to analogize. And if you go to 958605, sorry, you would have to analogize again. So in both cases, we find that there is nothing specific to our situation and that we have to analogize to it. Now, if you are a nonprofit who got PPP money, you know you are in 958. Now, the only strangeness about 958 would be this. We conclude that the loan represents in substance a grant that is expected to be forgiven. Now, when can we be forgiven? We can be forgiven as soon as we believe we've met the criteria. The timing of revenue recognition depends on whether the contribution is conditional. If it is conditional, you would not recognize it until the conditions are substantially met or explicitly waived. That's the key word. Now, if you have met the criteria, that's important. Okay? That meant you have employed the persons for the period you agreed to employ them. You have specifically or substantially met the requirements, whether or not it has been explicitly waived. However, unlike IAS 20, we cannot make an assumption about forgiveness. Now, this goes back to the 202-811. Why did we recognize revenue previously? We recognized the revenue because we thought the likelihood of not meeting the criteria was remote. And IAS 20 would have allowed us to do that because they're assuming that it's probable. So IAS 20 is similar to what we did in the past to say, look, I think it's probable that we will meet the conditions for assistance, to be forgiven. ASC 958-605 does not allow that word to be there. It has to be that we have met the criteria. The criteria are substantially met. So under a 202 or 811, we cannot substantially meet that criteria until the end. So nowhere in the future would a 202 or 811 ever be recognized as revenue again. And I think this is the most important thing to remember. I have a 202, not a 202, I have a client that is trying to, they do home loans. They take homes that have been abandoned or otherwise, maybe it was a HUD, FHA mortgage and the house is kind of in bad shape. The nonprofit buys the homes under a government grant. and then they rehabilitate the home, rehab it, and put a low-income person in there, and they, for the next 10 years, the loan is forgiven on that house ratably over a 10-year period of time each year, with qualifying low-income persons living in the house. And they get recognized, they would recognize revenue over that 10-year period of time because they're being ratably forgiven. Previously, they would recognize the revenue for the construction piece of that, the rehab model. They would recognize it all. And now the terms of the grant indicate it can't do that because they cannot substantially assume that it's not probable they'll meet them, because the probability phrase is gone. And now they cannot recognize revenue. This is going to have deep things for us. But in PPP money, this should be different because we could recognize under IAS 20 because we are good. It's probable we will meet the criteria. We could go under debt criteria, but we wouldn't recognize the revenue until we are been forgiven. And under 958, when we have substantially met the requirements for forgiveness, we could recognize the revenue. Now, that's a big deal for 958. I mean, for PPP loans. This is everywhere. The question you have to then decide is, where is the money going to sit? Is it going to only sit at the management company because we got the loan there? Or are we going to shove it down to projects, and how are we going to account for that? Or did the project itself get the loan, and we're going to meet the requirements? However, we probably violated the regulatory agreement if we had a loan. That's the summary of what's going on with PPP money. It turns out to be a fairly significant topic this year. I don't know. I would think that most of you should be able to recognize revenue on the loan in this period, but I do not think you will receive explicit forgiveness. However, if you ended up in a situation much like the this company was Novogradac, their client has this at a big Washington, D.C. law firm trying to make the decision about whether they can actually get forgiven or not, because they're over 500 employees and they had a couple of other problems. I'm really not handing out the memo for any particular reason. They were not unwilling to have me share the concepts in it. It's just that conversation was ongoing and nobody had reached a conclusion. And so it highlights how diverse or how many questions can be raised here in the PPP loan world in the last few months. But revenue recognition, if the management company is pushing it down to you, it's not a loan since you didn't have control, and you would only record revenue when received. Do I agree? Kim, it depends. So here's the story. If the management company got the loan and they want to push it down to you, the question is, can you recognize revenue? So you would go ahead and you would want to recognize the revenue, and under the model that you have just described there, I don't really have control over the note, but they have given me the money. Okay. Now, typically that resulted in a payable at some level. Somewhere along the way, someone has to recognize the revenue from the loan. If we shoved it down to each project, ultimately the revenue would be recognized by the project. Now, you could record it earlier under the theory that it's not a loan. But then how does the management company account for that? In the case of this one with Novogradac, what if they can't achieve forgiveness? Okay, and they shouldn't have given the money to the projects, but they did. Are they going to make the projects repay the money? So I think those are the questions. If you really feel good about getting forgiveness and you have substantially met the requirements, I don't think anybody has problems with recognizing the revenue. Because if you got it down, say the management company shoves it down to you, it's not a conditional grant to you, but are they shoving the conditional grant, I mean, through you? I mean, through them, are you receiving it? Or are you going to just say, look, it's my money, we took it, we recognized it, let the management company deal with it as you will? I think you can make any series of choices about this as long as you document what the positions were that you're going to take. Because the management company wouldn't be able to record the revenue until they think they've substantially met it. If they have substantially met it, and there are really very few legal questions about receiving forgiveness, then what you're doing either way is not a problem. Okay. Now, what you described, if the management company didn't get forgiveness, is not a problem. I guess it depends. Now, Brandon, if I were to walk through debits and credits on this, I think it all depends on what you want to do. In fact, let me just bring up a new spreadsheet, and I can't really write on anything here. I'm terrible at this. And let me make it really big. So let's just assume PPP loan received. See, I can't type anything. So we would have a debit and a credit. So DR, CR. Okay, so we would go, I would record cash, and let's say it's 200,000. And I would have PPP loan payable. 200,000. Okay, now the next transaction that probably occurred. Now, you may ask the question, why does management want to push it down to the project if management is a third party? They may not, but let me tell you what the problem is. If you're a third party management company and the owners of the projects are paying you, let's assume that you pay payroll so the next I'll show it in this next transaction. So let me just add in here a column. And this would be 1, right? So we'll go number 1. Number 2, payroll. Okay, so we have payroll expense. And then we're going to have cash. Now, in theory, well, I'm just going to say, let's call it $100,000. In theory, I could come up with another entry that was basically going to say this, AR from project, and I'm going to basically just reverse expense. So we could have done this differently, but I'm just going to do it this way. Okay, so now I'm saying I got a payroll from the project and $100,000. So then I would have to move over to the project now, and this is the management company. And then I could have gone over to the project here and done something else. Okay, and then we're going to go, let me just, sorry. Wasn't really thinking ahead on getting that done, but DR, CR. Okay, so at the project level down to here, I would have had payroll expense. And let's say I paid, that's a payable to management company. And I'm going to we'll take this at one project, 15,000. Okay, now what we're really going to do here is ultimately we're going to reverse this. Now, why May's asking a question, why would they push it down? Well, May, if I'm a third party and I contract with the management company and I'm a low-income housing person, and I pay you for this payroll, okay? So let's say I know that's paid. I paid you because HUD paid me and I paid you. Then I know at this point in time that you did not pay this. So I know that you got forgiven. How happy am I that I paid you payroll for an amount that you got forgiven? You're not going to be happy. Now, if I'm a totally related party, it doesn't matter because it's all cash within one thing. But if you're my third-party management company, those employees, technically they're my employees here, even though, because they work exclusively for the project, okay? Employees are exclusive. Okay? Why would I want to pay you when you've already been forgiven by PPP? So you went and got a loan for employees that work for me, and you got the forgiveness for it, but you didn't pass it down to me? Okay? Now, that's why people feel the need to push it down. So then at this point, we would have said, look, we'll reduce this to $85,000. Okay? For forgiveness to the project. So I had one project that was unrelated to me. So I gave them the credit. At some point, I would have to then take this money that was payable and recognize revenue for it, because I'm not going to de-recognize expense. The expense is still real. The employees are working there. So I would have to record revenue to offset it if it's pushed down. If it's not pushed down, then it didn't matter, but now I worry about, is the owner of that project angry because they know I got a PPP loan and made money off them. So they got paid twice. I paid them once and the government paid them once. Brandon, if the PPP money stayed at the management company, and then no disclosures would be needed at the project, that is correct. If the only thing would be however everybody felt. If it stayed at the management company, there's nothing down at the audit level. There was no revenue to recognize. There's no forgiveness to worry about. There's no loan. Now, some projects did get the money themselves, so you would have to deal with that forgiveness at that project. So, that's why they want to push it down. Why you may not want to push it down is a valid argument. That's why there are so many options here that needs to be discovered before you get too excited about one way or another. Because if this got to the project, you would have to decide when to recognize revenue for the money. And like I said, there are tons of consulting options going on now. This friend of mine out of Atlanta, he does a webinar, I think, every day, probably on PPP loans. Their firm has picked up, I think, over 600 to 700 engagements on preparing forgiveness documents, on consulting things about how to record accounting. The other side about this is you got an unusual transaction and you're getting another non-audit service involved in how to do this, but that whole process needs to be looked at carefully. Where did the money go? Who owned it? Who owns the liability? Are you going to push it down or are you not going to push it down? And then if you push it down, so let's say you push it down to the project here, this will invariably lead to surplus cash. Well, at least the opportunity to have more surplus cash. If you were at June 30th of this year and you did a mid-year calculation, so you have a 12/31 year-end client, you went and got PPP money at the project. We had a lot of questions about whether the loan should be put into the surplus cash calculation, because if you received money for payroll and you received, you really thought that was happening and you could get forgiveness, then you really ended up with a problem here, because you would have more surplus cash available, and that could result absolutely in more surplus cash. Was I required to put the loan on the books? I mean, not on the books, but in the surplus cash calculation? And the answer to that, as far as we can see, is no. You are not required to put that loan on the books. It's not payable from surplus cash. However, HUD did say, what did HUD say here? Did I close that already? On the question, there is a question about this from our last meeting. PPP loans. Q&A. Come on, Les. Where's the Q&A? Sorry. Okay. Remember, this was the question. Are PPP loans subject to the normal HUD subordinate financing rules? The answer to that is yes, but they did say HUD is reviewing its subordinate requirements for compatibility with the program, and it's told staff to approve them without limiting repayment to surplus cash for borrowers with market rate properties. However, repayments must come first from available surplus cash. So at some point you had to at least discuss the likelihood of repayment and decide if you were going to have surplus cash, because any surplus cash that you had would go to first repay the loan, and then you could use project cash. Holy mackerel. Sorry, that's way too much into this conversation, but I think you see the problem with PPP loans is fairly significant. There are lots and lots of questions, and we are only scratching the surface on them, and there are not many answers. We will not begin to even quibble with the idea that there are a lot of answers available. Okay. So no real disclosures, new disclosures other than how to recognize revenue, what the pieces were. The last thing, and I'm kind of a little behind, so I'm going to pick up the pace here just a little bit. We want to talk about debt extinguishment. The only other gap problem we see consistently, and this is across the board, okay, is what happens when we have refinances. Now, refinances generate 2 or 3 issues with regard to HUD specifically. And those problems are tied to, number one, it's almost tied to surplus cash always. Why? Well, the first question, or how? The first question is, are the amounts we pay up front to get this refinancing done, are they surplus cash related, or should they have come from project funds? And the answer HUD has consistently is no. They are not project related expenses, and so the entity should pay them. Now, the project hardly ever pays them, they just prepay them. And the proceeds are usually picked back up at the time the loan closes. However, we do get a pushback on this. Second of all, what happens to surplus cash in general, or excess cash from the project? That's clear. That money goes to the owner. It's not ever part of project. Oh, okay, Scott, sorry, I've got another PPP question that showed up here. Loan received at management company, but amount of loan is based on payroll at properties. If you don't push down, how do you offset expenses the PPP loan covered? Management company doesn't have enough payroll. Okay, so Scott, see, here's this continuing conversation. If the management company had employees, and some employees are really employees of the project, and other employees are management company employees, I am assuming they received a loan for all of those employees. Legally, those employees are employees of the management company. So payroll, the management company is responsible for payroll. The W-2s and such will come from the management company. The payroll taxes are paid by the management company. None of that ever becomes a legal liability of the project, even though the employees work at the project 100% of the time. So there is an argument that the PPP money did not need to be pushed down to the project because the employees legally are employees of the management company. However, the other side is basically true. What you say here is that the employees at the management company wouldn't have a job if not for the actual project sitting there. And so who bears the risk and who gets the reward and who gets pushed down to becomes a significant conversation of judgment. Because you didn't have to, if you had the payroll, when you file your payroll reports at the management company level, all those employees are listed on your payroll reports. It's just that you got reimbursed for most of them. Everything that worked at a project got reimbursed. So yes, if you left the PPP money at the management company and you got reimbursed 100% by the projects, this seems to me to be a very dishonest transaction of sorts, personally. Even though legally there's no problem doing it. It just seems to me, if I'm the project owner, I'm mad that I paid you for payroll you did not have to pay. And so they're saying the payroll would stay at the management company level. Nobody would come in and ask them enough questions to see that it was reimbursed. And so they're trying to make multiple arguments. There is no really good way to do this. If you took it at the project level, you could make the argument that it was never your payroll because the people legally worked for the management company. And it becomes a little bit more like what I used to do as I was a CFO of a professional employer organization. The PPP loan had specific exemptions for situations where the employer legally was the PEO, but the employees work for XYZ company. They're really their employees, but legally the states require payroll reports to be done at the PEO level. This is exactly the same situation, although there is no specific exemption for it. So you just have to make the choice, okay? Look, every argument that's been brought up here is a legit conversation. There's just no legit answers to them. People have to just make decisions and then decide how to implement. Okay, so when we go out and get a new loan, we always should come up in risk assessment and talk about this thing, because if this applies to all entities. The model was just this: are you a troubled debt restructuring? The answer is no. And so we're on to number 2. Is it a term loan? And if the answer is yes, which it is in our case, then is the debt extinguished or modified? Did we have a modification or extinguishment? And this is all we're really looking for here. Now, debt restructuring criteria was listed on slide 29. Don't really get excited about it. I don't think we see too many troubled debt restructurings in multifamily. But when you go to the model about what to do next, then we are discussing the difference between the reacquisition price of debt and the net carrying amount of the extinguished debt should be recognized as a gain or loss on extinguishment. So if we are going through extinguishment, so number 1, if we change lenders, we're on extinguishment. But more and more lenders now are certainly willing to agree to term changes on a loan that would help us or give us a little more concern about it being more of a mod. And this is all we're asking for people to do now, is to make this decision up front in planning and get it disclosed right in the work papers. Because if you then have an exchange of debt instruments with substantially different terms, it shall be accounted for in accordance with the paragraph. And if the original and new instruments are substantially different, we'll record the new one at fair value and use that to determine. But a mod talks about, look, we'll skip the conversion option, and we would go straight to this. Look, if the mortgage was done between the lender is the same lender, and they're changing terms, you have a very good chance that this is a modification and it doesn't qualify for extinguishment treatment. The only way a mod would qualify is if the cash flow differentials between the old and new debt are more than 10% different. So we're just trying to make sure everybody understands that in multifamily, we refinance extremely frequently, okay? A mortgage loan in multifamily, I think, has an average life between 6.5 to 8 years. So on a 30-plus year mortgage, the average life is 6.5 to 8 years. I mean, that's the range. So some last longer in the nonprofit world, but in the for-profit world, so some of these I have them refining every 2 to 3 years. And lenders have significant motivation to help them refinance and not lose the lending side of this, because the cash flow streams for servicing are worth, the money it takes to give them a revised interest rate. So anyway, let's just go to the end of this basic guidance. Is it troubled? No. Then is the debt modified or extinguished? If we change lenders, it's extinguished. If the cash flows under the new debt are more than 10% different than the old debt, then it's extinguishment. But if each of those is no, we end up with a modification. And this is from BDO. There are models around here for each of these. I think this one's PwC's summary of it. If it's a mod, we get no gain or loss. We get a new interest rate, and new fees to the lender are capitalized, and any fees paid to third parties, which should be minimal, are expensed. If we go to extinguishment, the lender, we write off all the old debt and we record the new debt at fair value. We get the gain or loss in debt has the gain or loss on extinguishment. This number should essentially account for all that expense differential from the old or new debt and hide all those other, I hate to say the word hide, it would mask all those expenses because we would just put it all in that number. Then I think there's another one, a mod, and there's one other summary on the test. Now, cash flows, all you do is run it into t-value. So I go to t-value, I look at what the net present value is on the current terms. I run the net present value on the new terms. If I'm more than 10% off, it's an extinguishment for sure. And then we get another model for EOI about how to record them. Now, insurance. I have one, there's just a couple of basic problems with insurance about understanding this. And then we'll be moving on because the time is going by fast. Now, we're going to go for, again, just like last week, we're going to go for 100 minutes. I think we'll keep that different, the breakdown to probably 15 minutes today, and then we'll go another 100 minutes. I think I'll look at the time when we're done here. Okay, so insurance, what happens? Well, look, you're going to get paid. So the first thing is, insurance is a control, by the way, against loss. The very fact that HUD makes us put certain insurance requirements in is probably an internal piece of internal control. Every asset we have is insured against some loss. Now, when we have an asset that's involuntarily converted, we recognize that loss immediately without regard to any expected recoveries. That does not mean that we can't offset with expected recoveries. It just means that the loss is made, where there's going to be a calculation of a loss. And it's written off whether or not we can recover it through insurance or not. Then we can also have impairments as a result of natural disasters. So we don't see that. Well, if you're in the hurricane zone, trust me, that could have been a problem. And I'll leave impairment. So this is just looking at all the ways assets can be involuntarily converted. Now, the proceeds. Receipts up to the amount of the loss are considered recoveries that may be accounted for when they are probable. However, gains, if you have a gain contingency, so recognizing amounts that are considered gains in excess of the loss, can only be received when the claim has been resolved. And that means either I've received it or we've got a letter or something like that. This is exactly the dilemma I'm in right now. Client has an insurance policy. How much of that was going to cover them for lost income and how much was going to be a gain? Well, they want to record the gain, but they can't. They can only record up to the amount of loss because we believe the amount of loss is probable, but the gain portion, we cannot allow them to record. And we're in a big furball gap conversation with them. And they're wrong. They're just not, they just can't record the extra amount until it's actually resolved. And that meant either I've got a letter, I've got the money, I've got something else, okay? So that confirmation is there. Business interruption insurance, again, anticipated reimbursements for lost revenue are considered gain contingencies and they must be resolved. And that, again, is a problem for this client. Financial statement impact for REACT's pretty simple. Getting it down into all fixed asset losses are probably going to come out of the repairs and maintenance area, 6590. It doesn't really make sense, but that's where it goes. The gains are 5990. And then, of course, you can record the rest of that. Disclosures, I think, are outlined good enough, and I don't feel I have enough time to go through the journal entries, but they're there, and I believe those journal entries work really well for that. Now, I'm just trying to get done here before our 100 minutes is up. Uniform guidance, when you look at the effective dates, we're talking about procurement in specific. That's the thing I'm bringing this up. Uniform guidance procurement is an issue for us. And that issue exists because 202 and 811 continue to have in the compliance supplements, and I'm just opening a compliance supplement right now. This is 2019. I could go get the 2020 compliance supplement. This kind of came up because of this issue right here. So here we are in supportive housing for the elderly. Procurement says yes. So there are no procedures related to this. If I go down here to procurement, you'll see that none of that comes up. We just jump right to special tests and provisions. And we are left with the idea that no more than 6 of these things at any one time can be marked as a yes. So you get activities allowed or unallowed, allowable cost principles, cash management, procurement, suspension, debarment, reporting, and special tests. 90% of our work is in special tests and activities allowed or unallowed, which is kind of funny. We do not have eligibility requirements marked as yes. So tenant file testing, it kind of looks weird here. So what about procurement? It's marked as a yes. So in both here and 181, so supportive housing for disabilities, we end up with a procurement requirement. and everybody had to go live last year, we started looking at this and we came up with this idea of the COFAR. And because people are asking us, what do we need to do with this? It's marked yes, and what do we do? What is the requirement? How much procurement does our client have to do? Because uniform guidance procurement can be onerous, although during the year COVID, it's not that onerous. It's really almost non-existent right now. What do I think about this? Well, if you really get interested in figuring it out, you end up with a question, and I can't really find this. Well, I thought I had it here on this I think I put it in your materials. Multifamily update, materials for reference. Single audit, PPP loans. It's 2C in your materials, 2C. And we are on question 320-5. Okay, does uniform guidance procurement standard apply to procurements made for indirect costs? For example, would a non-federal entity need to follow them when hiring a plumber to fix a broken pipe in the headquarters building? And the answer was no. Uniform guidance procurement standards do not apply to procurements made in indirect cost areas. They only apply to procurements for goods and services that are charged directly to a federal award. Now, that to me is the specific question. So when I come back to this federal award thing, I go back to, say, the uniform guidance requirement, and I ask myself, what would this be marked yes for? Because are we ever charging in years 2 through 40 to a federal award? The answer is no. There is nothing inside the uniform guidance requirement or inside the program where we are charging anything to a federal award. All we are doing is charging to a section, essentially what is equivalent to a Section 8 program. And we've already decided that amount is not even, it's an exchange transaction because it's subsidy attached to a specific person. So the PRAC money is it's not a contribution, it's an exchange transaction. We are not charging any of these expenses to a federal award. And in fact, if you go to the Section 8 program, you will note that has no procurement requirement in it. So why does 202 and Section 811 have a procurement requirement in them? The year we build the buildings, in that initial period, we are charging to the federal award. Procurement had to be done correctly. But in the years after that, we are not charging to a federal award at all. So essentially, in multifamily housing, we hardly ever see a uniform guidance procurement requirement popping up as something we need to test. So hallelujah, that is something we do not have to do. So we can get past those. And the last thing for the matrix, one of the bigger questions, and it came up in our last conversation, is what are we going to do with regard to EIV? Now, the HUD Audit Guide tells us when the requirements change, we have to change with the requirements. Single audit used to say that. So in the matrix, let me go back to this requirement. It says compliance requirements. Now we're talking about N here. This whole piece of language is a change. This is a new phrase. So it tells us we must determine which to do, If they're marked with a yes, and then determine which of the compliance requirements that are subject to audit are likely to have a direct and material effect on the program at the auditee level. And the answer is procurement's not going to have one, right? For each such compliance requirement subject to audit, you must part 3, other than which includes any program to perform the audit. When a compliance requirement is shown in the summary below as an N, it has been identified as not being subject to the audit. Auditors are not expected to test requirements that have been noted with an N. One of those things would be eligibility. Now, if you look at this, we are not required to test eligibility under a 202. So what would we tell everybody? Well, we put the right places in. That's activities allowed and run allowed. We're not charging to a federal award now, so I hardly think that's required. Allowed cost principles are allowed. Now, they may dovetail with the regulatory agreement. Reporting, there's something under, so we had reporting marked as a yes. Financial, performance, no special reporting, and we go down to special tests and provisions. So when I'm looking at this, wage rates, use of project funds, replacement reserve, residual receipts, nowhere in any of this requirement are we told to test tenant files with the PRAC. Not even EIV. I mean, especially not even EIV, but not even tenant files. Their eligibility is marked with a no. So that removes all of those requirements from our perspective. Now, when you went to Section 8, you would find Section 8 marked with that. So you would see under 14,195. Eligibility is marked with a yes. So whatever requirements, and you had things here, none of that's listed in the 202 or in 811. So that's a pretty big statement for multifamily housing to be free of that requirement. And that hasn't changed in the 20 supplement either. Okay. Now the 20, I listed the two differences, and that's coming from Section 3 or Part 3. But that you see that marked in each matrix now, where N says we don't expect you to test anything marked with an N. Okay, now we got the last few minutes here to just talk about a beginning of internal control. Now, the reason I'm going to use this or stick with this is that there's a thing coming up. As soon as the break is over, we're going to play Kahoot. And there's a question coming up in this Kahoot about this. So I just want to get down to definitions. Internal control and the UG definition. I like this. To me, although it's UG, it is uniform guidance, but I think it belongs no matter what. Robert, okay, look, can I make an argument that the eligibility tenant file testing would fall under allowable activities and leasing to low-income individuals? Okay, a good question. Awesome question. Let's go back and just look at what the supplement tells us. Okay, so activities unallowed. The project shall not provide shall provide the necessary services. They'll only be used for reasonable and necessary expenses of the project. That actually dovetails very well with the regulatory agreement. They cannot include certain things. There's some things you can't do. And the project must be modest in design. And this only applies during construction. Okay, so services are not being provided that shouldn't be. Project, in fact, let me just add a little comment into here onto the side. Add text, right? Okay. What services are being provided? And I think that would be, does that really apply to eligibility? Then I would go to the next one and I would say, okay, this one is really related to our cash disbursements in special tests and provisions. Okay? This is all about the design, and then services, prohibited services, because we don't want to really cross the line and become an assisted living facility. And the last one is only year of construction. So if you wanted to test, so if you're really into this and you're saying, I want to test them, I don't know why you would want to do that. You could theoretically find your way up in there into activities allowed to run allowed. Now, allowable cost principles to me really comes back to saying this whole decision here. So I'm going to just highlight that again too, although it won't let me highlight it. I'll put that in red text. Won't let me do it. Oh, it did highlight it. Okay. I just don't see, you can, look, if you're, how can I prove a negative? All I'm saying is that there is no requirement to test eligibility. If you want to test eligibility, then you can go test it by whatever reason you want to do that. But I don't think anyone can come into this and tell you, as a peer reviewer, because I'm going to go right back up and say, when a compliance requirement is shown in the summary as a no, it has been identified as not being subject to audit. We're not expected to test requirements that have been noted with an N. That's a new statement, by the way. That started only in 19, so you can see that. And I would argue that why would I ever try to make it up? What on earth would make me go do this? Okay? So I think you're out of that. The only time I'm testing tenant files at all is in the Section 8 one. And then I have no cost issues, no activities allowed or allowed. Cash management's really a different conversation. And this will be covered in our single audit day. I just thought that for most pieces, for an update course, that was the change. And I don't, if you can make that argument, then I guess you'll have to look at it. I don't see how I do make that argument, okay? I think the stronger argument is that it's marked as an N and I don't have to deal with it. But again, mileage may vary. So if there are more issues with that, I'm happy to have that conversation. Okay. And just to get out of here, we're 2 minutes away from the break. Internal control means a process implemented by the non-federal entity designed to provide reasonable assurance about effective operations, reliable reporting, and compliance. 68. Now, the key for most of my conversation later is this definition: internal control over compliance. Means a process implemented by the non-federal entity to provide reasonable assurance about the following things. Transactions are properly recorded and accounted for. Okay, so actually accounting, bookkeeping, where things go when they get recorded in the ledger is part of internal control over compliance. What else? Maintain accountability over assets. And number 3, demonstrate compliance. Transactions are executed in compliance with those 2 requirements. And last but not least, funds are safeguarded against loss. That's a broad definition. What about for a 14155, which is not in the matrix, Kim? Sorry, I forget. If you're talking about an insured mortgage, since I don't remember which way everybody records insured mortgages. She said yes. Okay, now, Kim, with that one, that's a whole different story because there's no compliance supplement for it. It is an insured mortgage. In that case, the HUD audit guide, which we're going to look at here right after the break, is going to make us follow the HUD audit guide. But you still would not, unless you had a subsidy program, you would not be doing tenant files. So the subsidy program, sorry, 14155 would force you into the HUD audit guide, and we'll cover that after the break. Okay? In fact, that's one of the biggest topics that is in our single audit, our 4-hour class, is how to transition from no supplement to the HUD audit guide and the documentation stream that's required. So just remember, we're going to come back and play Kahoot. Now, I think we are at 11:41. I'm actually, it's 11:41, so I'm probably almost going to be 2 minutes over deadline here. We're going to go till noon. So I'm on Mountain Time, so that means I'm at 11:40. We're going to start again at noon, so we'll start in 20 minutes. And well, that might now be 18 minutes. So we'll start at 18 minutes, but we'll start at 12 noon, and we'll be right back. Sorry, 12:01. I forgot to turn on my microphone. It has been pointed out during the last 20 minutes that I'm an idiot. Now, the person who pointed that out was a lot kinder than that, but my point is that I am an idiot. And nothing can change that, really, except the fact that I'm sorry. On the 202 compliance supplement, on this eligibility, it was pointed out to me that when you went into the 202.811, you will find that actually was changed last year and is changed back to a yes. I mean, it is marked yes now. Which kind of is an interesting thing, because they had to have no more than 6 in there anyway. And so I just opened that up and was going with the no thing and looked at eligibility and said no, when my point was really going to be you didn't really have to do EIV. And so that was a little problematic that I said that. So Darren, thank you very much. You were kind to remind me that last year this original Section 202 that came out did have this marked as an N, and people did get excited, but it was corrected later in the year, and in the 2020 supplement it says yes. In the later version of the 2019 supplement it said yes. The only point I usually, in fact, this is the only time this entire year that I have said what I said at the close of our last session, because I'm so aware of it, but I just got carried away at reading that thing as a no. So it is a yes, and my only point that I should have ever tried to make with it is that there's no mention of EIV, so that when you look at auditing remotely, you have complete access now to everything you need to audit remotely without having to go to the client's location, and therefore you are out of the woods with regard to some of those EIV issues that still linger in multifamily for-profit. Thank you, Darren. It's kind of sad when you get, you realize, look, I do it every day, so I mean, I don't expect myself to not make mistakes, but that was kind of a big bonehead move. So anyway, that's the clarification. Now, we're going to play Kahoot. Standards update. My favorite music here. Okay, so everybody back on your phone. You watch the computer for the Kahoot game. Answer on your phone, kahoot.it. The Ginger CPA. That's not bad, Rev Rec. I like that name. Man, I can't believe I messed that up. Let's see, what do we have today? 140 people. Well, we're paying top 5. 1 through 5 get paid today. Are you telling me that I need to retire? Oh man, doesn't that seem like a truth statement? Probably no more truer statement will be said today. But I'm still here. Quarantine. Do. Come on, I got to get better than 50% of you in here. Toot for Kahoot. I hope not. Ah, my nose is itching. Okay, we got 90. Paying top 5 per people. Get on the board. This was effective for fiscal years ending after 12/31/19. It's kind of a trick question. It wasn't meant to be really when we wrote it. It just kind of came out wrong. That is true. Now, it was effective for year ends beginning after 12/31 or 12/15/18. But that was what we're looking for. 53 of you got that right. FIA, DDW, the Penny Patrol, CB and KTC, and your boy, close, 5.3. Hey, I've never seen 3 people tied at the same score, ever. Not even after just one question. Which of the following was true regarding 2018-08? There are 2 correct answers. You must select 2 answers and then hit enter. Try to hit 2 and hit enter. Section 8 payments are exchange transactions, and this is true. 2018-08 does pertain to payments that benefit the general public. They're just contributions. Please top 5 is number 1. Coming for you is number 2. BTR, ask, and let's play. A contribution is conditional if both must exist. The barrier and the right of return must exist. Let's play. MS, top 5. Coming for you, Justy. Which of the following was the most populous state capital? The picture is a clue. Phoenix is the most populous state capital. Out of those 4. MS, you got to the top. Hey, please top 5. You're still in the top 5. Coming for you, Oh No, and BTR. Does a prac constitute a barrier? Yes, it does. It has you looking at people, making sure they are recertified every year, that their income is correct, that the subsidy is correct. So it does constitute a barrier. Less than half of us got that. MS, please top 5. Hey, you're staying in there. In fact, you're really close at this stage of the game, so only 54 points off. Coming for you, BTR, and Oh No. But we're still pretty close, 1 to 5. Which of the following items is a barrier? Report conveying specific research results. That is true. Money showing how a grant was spent is not a barrier, and because it's coincidental. It's not part of the purpose of the grant in most cases. Financial statements are coincidental. They're not purpose of agreement items. Detailing hours spent probably isn't either, but the specific research results is. That was the purpose of the grant. Top 5, you're back at the top of the top 5. Oh no, MSNT and coming for you. We now have almost 1,000 points between 1 to 5. Now this is a new trick in Kahoot. Kahoot's upgrading for corporate stuff a little more. Put these in the proper order. Which one is step 1? Which one is step 2? Which one was step 3? Which one was step 4? I tried to say this like 3 or 4 times. Step 1, if then apply step 2, otherwise apply step 3, and then follow step 4. You have to just put them in the proper order. New Kahoot challenges. The first 2 are already in good order. Is it an exchange or a contribution? If exchange, apply 606. If it's not, apply, determine if there's a condition. And to do that, you examine the rights of return and the barriers. That's the proper order of 958605. I know it's kind of a tricky deal. We just found a place to use it. We're exploring new options. Apparently it's not a very good one. Please top 5 is in the top 5 still. MSNT coming for you, and oh no. And we are just under 1,000 points from 1 to 5. Which city is the only American city to have risen above 1 million in population and fallen back below? Do not hesitate to look at the pictures. Detroit, that was a picture of Detroit. Coming for you, zipped up to the top, please top 5. NTMSMJ, and Emily's climbing up fast. There's only one answer, said multi-select, but there's only one. Is this applicable to a Section 202 prac? Yes, but only for construction. We are in complete agreement, all 39, or you're in complete agreement with me, so yes. Coming for you, please top 5. Wow, we got it down to close. Just about 150 points. MJ, NT, oh no. And 3 of you are at 5, or 5, 8 of you at 3 in a row. The supplement eliminated the need to expand testing for items not in the supplement. True. Just be sure you're looking at the right supplement. Darren, I am so appreciative of you clearing, forcing me to think about my own actions here. Thank you very much. 55 of you, way to go. Coming for you, please stop 5 MJ, NT, and oh no. And 6 of you are now at 4 in a row. So the bonuses are big. It's getting tougher to compete here. 2 questions left. Uniform guidance defines internal control over compliance. Every answer there is internal control over compliance. That's a key factor to remember. Okay, it all comes down. Hey, Toby Flenderson, you've made it onto the board in spectacular fashion. MJNT. Man, Toby, I don't know where you're at in terms of the bonuses, but Ben Carson's coming up. We coming for you in top 5 are fighting it out for 1 and 2. Everybody else, I think, is coming up below, so the rest is in flux. I'm not sure that Toby can catch the 8,600 group. It's close. He might be able to overtake one of those. But here's the final question. At the 2020 census, the mean center of U.S. population is found in which state? The picture was a good clue. Toby, you got money, buddy. Top 5 took second. Coming for you. You came for my money. That's good. MJ and MS brought up the top 5. Okay, if you know where you're at, 1, 2, 3, 4, 5. Email Kathy at ahacpa.org. Just give her your handle, tell her which position you were in, and gift cards will be coming out at the end of class today. Way to go, top 5. We appreciate you playing. We'll play again in a second. Well, not a second. We'll play again in just about an hour. Okay, now moving on to section 4, risk assessment. This is going to turn us a little bit more over to the HUD audit guide. A little bit of RD at the same time, but we're going to address this a little differently than maybe would appear on the surface. When you look at what peer review is looking at, in fact, I probably would just say, peer reviewer focus. I should probably change that slide out to be peer reviewer focus. We've already addressed the yellow book and in particular non-audit services. We did that a week ago, and we've addressed kind of the key issues really with single audit until we really get into detail, which is really about how do you audit an insured mortgage in this world without a compliance supplement. Then you get into the other standards about professional things, testing, risk assessment, controls, and we're certainly still on that kick. I've been through 2 or 3 other peer reviews in the last month or 2 where people are calling up and asking for guidance, either the peer reviewer or the reviewee, in some cases both. and asking about how to apply some of these things in HUD. Now, the one place where we just can't seem to get agreement in particular is how we apply to or respond to independence and preparation of the financial statements. The risk assessment side, we can get a little closer on most of the time. Now, the goal of this session for the next hour and 20 minutes is to really get down about how the HUD audit guide solves most of our problems in risk assessment. Now, you don't know that yet about how that works, but we're going to go over it and what we should be doing for most of this to happen in a HUD audit guide environment. And that should translate over to RD the same, okay? Because for all intents and purposes, there's so little difference between the two that we can talk about that as we go through here. But when you look at what the standards are talking about, we're only going to really address maybe the top two things here. Failure to appropriately document planning. I just really struggle with planning documentation has an indicator of how well or not how well a CPA responds to professional standards. The idea behind, lack of appropriate planning is an indicator that says the audit had to fail. When you have an audit guide and that audit guide lists fairly comprehensive procedures, at some level, what does risk assessment really mean to anybody? I mean, aren't you going to just follow the HUD audit guide? And then why would I do some of these other requirements? If I follow the guide and I answer the procedures appropriately and document the procedures appropriately, then my audit should be pretty good shape. That's kind of the opinion I guess we should have, but it doesn't appear to be enough or significant enough of a reason to justify, all this focus. So we get more focus because it just doesn't seem to be enough. Anyway, you get down to this, and even a little bit about fraud. The audit guide, both RD and HUD, should prevent most of those questions from occurring. But we're not taking credit for the way we see things. Now, look, from a risk assessment, couple of these slides are the same as last year. So we're supposed to look at the entity and its environment, including controls, by considering classes of transactions, account balance, and disclosures. That's, I'm just quoting AUC 315, paragraph 27. Then you're supposed to assess those risks you identified to decide whether they relate more pervasively to the statements as a whole, and therefore many assertions. And in particular, you could say equity skimming is one of those. Now, because equity skimming would affect cash in, cash out. There's so many places where equity skimming could occur that it would be, really at a financial statement level as a risk. Relate the risk to what can go wrong at the relevant assertion. So based on what you think that can go wrong, then tell us what the assertion level risk is. And then you think about the idea of having multiple misstatements that could result in a material misstatement. Okay. Now, most of us can read that. Brian, that shouldn't matter if you had question number 6. I don't know. That tells you poll number 6 was where you were at. I don't know where you'd been through for that. Remember, you only have to answer 2/3 of the polling questions issued during the day. So let's think about this. If there were, it's 4 hours, maybe I think the minimum of 3 questions an hour is what we're required to do. So that's 12 questions. Therefore, you have to answer 8 of those questions. So if you've had everything before 6, and remember, we were at a break. So that break, you might not have missed much during that time. So you might have missed 1. I'm guessing 4 were before lunch or something. I don't really know. Did we start one right after lunch? I don't know, but we're on 6 right now. So you only had to get 8 out of 12. If 12 is the number for the day, you only had to get 8 of them anyway. Okay, for the risk assessment, we should look at our understanding of the entity. Oh, we did that. So 28. Let's go to paragraph 28. We should determine if any of these risks in our judgment a significant risk, and we should exclude the effects of controls. And when we decide that, we're supposed to look at a couple of challenges here. What things could result in fraud, significant economic, accounting, or other developments. Now let's just, well, I'll go through the rest of the list. Complex transactions, that's a refinance. Related party transactions, depends on the organizational side for this. How much subjectivity or transactions outside the normal course of business. Let's just take 2020 has a basic year for everybody. And what do we know? Well, we know the CARES Act is in place. So COVID is a risk. Even at this late date, you know, we are still having changes in mask mandates or all these little things like that in society. But in multifamily business, we're struggling with loan forbearance. I mean, let me start back at the most basic. Eviction moratorium. So you can't evict anybody who doesn't pay the rent. Does that mean receivables are increasing or decreasing or staying the same? That really depends on the project, because if you're subsidized, receivables should not be going up. They should be staying flat. But that assumes everybody had processed all their recertifications on a timely basis, or they're getting them caught up now. But if you are in a for-profit entity, no subsidy, you could be building a significant receivable balance because people found out they do not have to pay their rent, and at least for the moment, and cannot get evicted for it. So receivables may go up. You may have increased costs. So that risk of the year being under COVID represents some fairly interesting opportunities for risk assessment. Then you have PPP loans. What did everybody do with that? Okay, and then how are we going to record the revenue for that? And how much subjectivity was there in any of that measurement? Of course, most of this is outside the normal course of business anyway. So we do have, during this year, a little higher risk factor on how we do this. Now, let's just look at AUC 935, Guidance on Compliance Audits. When we look at AUC 935, we're told or shown that there are 7 specific requirements coming out of the standard. And this is just applies in every case where we have compliance audits. So single audit, HUD, RD. We would apply other relevant AUC sections. We would establish materiality, and we're doing that. I don't think there's any change at a level that needs to be done there. We identify the programs. Now, in particular, identifying programs and looking at what is required. Well, I'll get to that in a minute. Then you're going to perform a risk assessment. How do we perform risk assessment on compliance? They're going to tell us. Then you're going to perform the further audit procedures. Then you get the reporting on internal control and compliance, which every compliance audit we're required to do has a very unique reporting structure, more than the Yellow Book at major program level, and then how to document all this. Now, for each program or compliance requirement selected for testing, we should perform risk assessment procedures to obtain an understanding of the applicable requirement and the entity's internal control over those. As part of these procedures, we should inquire as to the results of other audits or monitoring procedures as indicators of compliance. Now, I get 2 comments coming out of that. Okay? We put this together. This is in your materials. It's called Session 4D. When you look at the materials for reference today in the class, you should, I think here, multifamily update. Sorry, I'm not seeing the material link that I wanted to do here, but when I look at it from our perspective, you should see this spreadsheet down in a little matrix, depending on how you got it listed. It's called 4D Compliance Matrix from Easy Audit. Okay, this is what it looks like. What we've done is we've listed the program types out across the top, major, non-major, and we list the HUD Audit Guide procedures down the left. And then we've tried to establish inside the matrix which program requirements apply to which program and when. Now, there might be notes like number 1, you could go down and say, well, depends on the federal awards expended. Okay. Oops, don't do any of that. That's bad. Cancel. When you go through this process, now, for those of us who are looking at this, I've added column F here simply as a tie to uniform guidance, because once you are told under the HUD Audit Guide you have to go use the HUD Audit Guide for compliance supplement purposes, what you have to do under Part 3 is identify the requirements or align them with the 12 types of compliance requirements that uniform guidance has. So we've taken the audit guide and aligned it into, taking each section of procedures and put it into what the audit guide or the 12 types of compliance requirements would indicate. So we would have had that list out here. That's just, this doesn't affect the for-profit audit, but it's for a nonprofit audit where the program is a insured mortgage with no compliance supplement. Now, I could have probably, and the only point for showing this is when you go through and you decide what your regulatory agreement requirements say, and you compare it to the audit guide, that is part of risk assessment. So the very effort of going through and identifying the compliance requirements applicable to each program is part of risk assessment. What's the next part? We ask, what has anyone else told us? Sorry, I'm just looking at the Q&A here for a minute. Bruce, that link for the compliance matrix, that did work for me. So I don't know if that doesn't work on your end, then we'll have to come up with a different, then maybe Michelle will just email it to you directly, because the link is working here for that. And Michelle, maybe that's just the option to just make sure you can actually email that person and get them the file if the link isn't working, because it works here. So anyway, the next question was about making inquiries. What does this remind us of? In fact, I probably should have always put a note in here, and this should say reminds us of HUD Audit Guide requirements to report in the schedule of prior audit findings. Okay. Oh, should have closed the print out there. So the point I just want to make is that when you make those inquiries, you are actually establishing the requirement or the data. You're obtaining the data that would use to report in the HUD audit guide requirements to report in the schedule of prior audit findings. So when you make these inquiries, it's risk assessment. And then we turn around and report the results of that in the schedule of prior audit findings, parts A, B, and C, or parts 2 and 3. So once again, the audit guide is giving us risk assessment assistance. Then we use that risk we use the data to assess the risk and determine further audit procedures. Now, the question is, if you have a HUD audit guide, and we're going to go over this, which one of those, what does it matter? If I have audit guide procedures, don't I just need to do that? Well, apparently you're supposed to go out and do risk assessment. And that risk assessment would help you determine the need for further audit procedures and how much you would go, like sampling. So now the next step under 935 was to develop an overall plan, design further audit procedures, including test of details, risk assessment procedures, internal control and analytical review alone are insufficient. And this should include preparing a risk or a test of internal control if risk assessment procedures indicate an expectation of effectiveness, may or may not be true. Substantive procedures alone are insufficient. Yeah, I don't know if that's actually true or not, but such tests are required by the government audit. And now that is true, and only one of those has to be true, right? Only one of those conditions has to be required for this to apply. So HUD, RD, and single audit all require such tests to be performed. Now we'll come back to that in just a second. Then of course the report is fine. And we would have the reporting is fine. Now with the internal control, we're going to go over here a little differently. But I'm going to finish all the slides before we break out into the HUD audit guide or RD. So we've already looked at the definitions of internal control and internal control over compliance. We won't need to look at that again. However, just note and tell me where you think internal control over compliance ends and internal control over the financial statements begins, and see if there's a bright line between them. I do not find any bright line at all, ever. Now, the non-federal entity must, and I think this would go hand in hand with the audit guide. Excuse me, although this is just nothing but uniform guidance. The non-federally must. This goes to both HUD and single audit. Establish and maintain internal control over the award. Comply with terms and conditions. Evaluate and monitor. Take prompt action. There's nothing there that any of our clients are not required to do. That's impossible to not get stuck with those requirements. So we get a lot of increased focus on here. And I'm going to skip all. What we typically hear is the next 14 slide issues. Less complex entities, why bother? It's a waste of time. I won't find any real controls. It's too difficult. And then they ask us this question: can you really assess risk and design further audit procedures without that evaluation? Now, for the most part, this problem comes up in relation to a form. Oh, I guess I can't type when something else is popping up on the window, huh? Okay, now this manifests itself in several ways, but the most significant one is here. I would say it's about a 90% penetration across the country that we would come down here, and I don't know that I would, we'll just ignore this one, inherent risk marked at high, because I think it's more likely that people generally get down to the assertion level issues. And so instead of trying to do it by audit area, and I think that would, this one is supposed to be deletable. But it's very common for us to see this. Man, I cannot highlight that enough. Now, what does this mean? This might mean a couple of things, and this is where we get into trouble. Does this mean that there are no controls? Or that the controls aren't working? Or does it mean that we have assessed controls but do not plan to rely on them? The form here is leaving us in a little bit of limbo because it's not clear exactly what we intend to say without more commentary. In a HUD audit guide world, the question is, can you actually do this? I am not sure that this is possible. I personally believe this is not possible. Now, it could be possible that they're ineffective, no doubt about that, okay? But should it be possible that really it's high because we don't intend to rely, or we didn't assess, or we assessed, it's possible that we assessed and they're all junk, there are no controls. But then we better accompany this with findings, or we just decide not to rely. That last one is not really possible because you are required to test internal control over compliance. And how can I get, and that includes both cash receipts and cash disbursements. So this becomes problematic for almost all auditors in the multifamily environment. Now, what would we say about this? I can't really come up with too many issues here. It can't be a waste of time. I have to do it. It can't be too difficult. It doesn't matter. I have to do it. And there have to be some controls. And if not, then they get findings. So this kind of risk assessment mentality in peer review is what they're telling you is that you can't really, if you're not linking your procedures to risk, well, because you haven't assessed risk correctly, how do you know the procedures are right? And relying on the HUD audit guide isn't enough. And I've even seen this brought up now, AUC 585. I'll bet most of you didn't know what that was. But consideration of an omitted procedure after the report release date. Wow, that has been brought up in peer review. And now we see it advertised by the AICPA. Now I'm going to get back to that as long as we talk about, as soon as we finish this conversation about internal control. And we'll just talk about why the HUD audit guide should prohibit most of this from being an actual problem. Assuming the client has, oh, by the way, this was taken from the Journal of Accountancy. It's one of the rare moments in time I've quoted the Journal of Accountancy. I thought this was a very, very well-placed and well-timed article. What do you say about the client has no controls? Well, that could be common with a HUD project. theoretically, but essentially everybody has some controls. Does management have a culture of honesty and ethical behavior? Do they require login stuff on their software? Does management review the statements? If the answer to any of these is yes, the client has controls. And I guess the point being, number one for me, and this has been a big change in my mentality, is remember, we're not only considering control activities. There are many other controls in place that are not tied to control activities. So that's a good thing. But they're only one of the components out of the 5 components. Now, 315 does not require COSO, but 315 does require that we address control environment, risk assessment, control activities, reporting and communication, and monitoring. So each 5 components of that COSO cube have to be addressed. So the client cannot, in our case, the client does not or cannot exist without controls. And we'll prove that as we go through it a couple of seconds. Not understanding which controls are relevant to the audit. Okay, now once you identify a list of controls, the goal would be to assess what is relevant. And that is a big judgment call. Okay, and it's not related only to things you plan to test. And we're going to get some weird stuff. We'll be able to point out a couple of things about this. I have some very specific examples. So these are things that we judge are necessary to be able to assess risk at each assertion level. And there's some that are always relevant because they address significant risks or places where we plan to rely, or substandard procedures alone don't provide enough audit evidence, or they support journal entries. Man, I've got one of those journal entry problems right now. So, misstep 3, stopping after determining controls exist. I mean, that's essentially not walking through, going through a it just didn't make sense the way I was trying to say that. Performing walkthroughs or some other documentation process to ensure things are working. So do the bank statements get received unopened, and how do we obtain the evidence of that? Last but not least, improperly assessing control risk. So defaulting to high without considering controls, because after all, we're not going to test them. We're going to mark no. That is not allowed. We still have to assess. You cannot just default to no. And so in my world, if you're going to say no on CX71, you need to be able to explain why or what is going on that puts you in that position. And it could be ultimately that we will not test for reliance. But the documentation behind that has to be better. And you can't lower risk without testing controls, at least enough. And then last but not least was the linkage issue. And that should be relatively simple with the tools you already have. Now, having said all this, what does this mean to me? Okay, in the HUD Audit Guide. Well, I'm going to approach this a little differently, but I will open up the HUD Audit Guide here for a minute. And talk about how we would do each of these risk assessment things. Oh my heavens, why couldn't I find that so easy? Okay, Brandon, does internal control testing need to be documented separately from substantive testing, or can we gain coverage from other testing and note the internal control testing? I guess it depends exactly on what you're trying to do. There are some internal controls that we should be testing that are not really tied to substantive testing. For instance, bank reconciliations or a couple of other things. They really don't have a tie into substantive testing. So when you look at the bank rec, you are generally going to be testing for the controls. Now you might say to yourself, does the reconciliation show that the bank statement and the general ledger are in agreement? And that's ultimately heading towards a substantive procedure. But the process of the reconciliation is always a control, if at least being done correctly. So in general, that one is a little more difficult to segregate. However, when you're in cash disbursements and you have substantive testing involved, if you are adding attributes to your substantive testing that would document a control, such as would an invoice be approved? So is there a sign that it was canceled or that it was otherwise approved? That would be part of your substantive testing, and we would be doing a dual purpose test. In fact, at some level, you would be doing a quad purpose test, because you're really doing internal control over compliance, internal control over financial statements, and internal and substantive testing on the balance. And a cash disbursements test could achieve all of those at one time. So it is very much possible to have a dual purpose test. And when you look at the guide, the ANA guide over government auditing and single audit, it's going to talk about dual purpose testing. And there are some criteria that we're worried about, and I'll get to that in a minute. So yes, Lilibeth, you can do a dual purpose test. Now, there is a little bit of a concern about dual purpose testing that I will, I guess, bring up at the moment. Let me just show you what the AI CPA says about this dual purpose testing problem. And I'm really close to it right now. Chapter 22. Okay, now this is hard to read. So this is from paragraph 2152 of the ANA Guide for Government Auditing Standards and Single Audit. And it's going to tell you right away, and I don't think I can make this bigger. Oh, I can. Yahoo, I did. Something is working today. But I can't apparently get that any better out here. It's good to, the most common dual purpose approach in uniform guidance audit is testing operating effectiveness of a control and testing whether the auditee complied with relevant statutes. For example, subrecipient monitoring. If a sampling unit is a subrecipient, you can go there. 2153, when testing both the operating effectiveness as a, boy, that's going to be hard to just deal with consistently, isn't it? Having to deal with that. When testing the operating effectiveness of whether the auditee is a type of compliance requirement, the basis of this further, a control that is not properly applied to a transaction may not necessarily lead to non-compliance. We might reach bad conclusions. We should be, in dual purpose test, findings should be evaluated separately for the control attributes and the compliance attributes being tested. So you can certainly use this. And another example is multiple purposes when auditors wish to use single sample for testing both UG and financial statement objectives. Now here's my problem, where they said the problem is because of this issue. So such an approach may present additional complexities to consider because there are often different characteristics. And then it says, although it is challenging to select the sample that achieves both, it can be, they do occur. Let me just say this, they do always occur in multifamily housing. So if I have to look at this, and there are plenty of peer review people and overall views of this that say, well, I really don't know that I should dual purpose test. And they get that from paragraph 2156. And so saying, look, it's kind of hard to look at UG going one way and financial going another. But in multifamily housing, they're always the same. They're on parallel tracks. In fact, I can't actually say they're separated. They're together because there's no separation of the financial requirements from the compliance requirements, because everything you record in the general ledger of a multifamily housing project is subject to compliance audit. Is it a reasonable and necessary expense? Did all the expenditures make it to the project? So in multifamily housing, no matter what else you read in 2156 here, 2157 indicates there are places where it does occur. And so indications of compliance with relevant statutes, compliance over allowable cost principles, indications of performance of internal controls over both allowable costs and cost principles, and appropriateness of the expense for financial reporting, evidence the recorded amount, account, and period are correct for financial reporting. Those would all be things we would do, and that's a dual purpose test. So absolutely, Lilibeth, you can. Now, Randall, what you get out of that conversation is that yes, you need to be able to separate the two components from each other. Which one of those attributes was the compliance or the substantive piece for book purposes? Which part was the internal control piece? So when you look at having a cash disbursements sample of, and we'll go over some of those in just a minute, then you need to have something that shows the distinctiveness. I would highlight my columns in different colors and show we're going to be looking for some approval. And it depends on what you choose to pick, okay? Now, having said all that, let's get back to the audit guide. Oh, did I not bring it over here? Oh, I opened the wrong one. Sorry. That was not good. That was a chapter 3, but it was not the audit guide chapter 3. And I think this is actually in the materials. I've highlighted one here a little bit. Now, chapter 3. Sorry, I don't know why this is hard for me at the moment. You know, it's not like I don't open this up every 20 minutes. Okay, chapter 3 of the HUD audit guide, the marked. This is session 4B. If you look at your materials, you'll see 4B. So Michelle will probably just post a link for that, and for someone who can't get the direct link, she might just email it to you. I want to just go over a couple of things here in general before we get into the actual pieces of this. One of the things I have a hard time convincing people of is the usage of dual purpose testing. Now, dual purpose, look, the audit guide hasn't changed in 12 years. It was issued in 2008. It's 2020. 12 years later, what do we still have going on here for that? But the challenge here is this. If you're auditing in a multi-project environment at the management company, so you have 30 projects at the management company, you're always faced with the idea of doing group project-based sampling. Now, group project-based sampling is allowed in very specific circumstances, and people choose not to do it for tenant files. The number one place where we see it would be tenant files, so 35J, tenant application eligibility certification. But the place we really, and they do not do it there because they're afraid of findings. So there's a requirement that says, look, you got to do it on a minimum of 4. Every project is sampled every 5 years, which kind of gets you to this 20% idea. Owner has to agree, and if there's a finding, you report it on all the projects. Well, tenant files has a tendency to generate findings once in a while. Okay. However, security deposits and management functions may not have that tendency. So if you really want to reduce testing, I would really look at that. And if you're unwilling to do it on tenant files, you should do it on management functions where you're much less likely to get an issue. Plus, you don't want to be stuck with work order testing and some of these other things that are in there. And you can reduce, there are more, gosh, there are almost as many procedures in management functions as there are tenant files. And you can get rid of that on 80% of your jobs. Okay? So remember this. Now I'm going to address RD for a minute. RD specifically says what? You cannot apply the group project-based sampling methodology outlined in the HUD Audit Guide. In other words, they will not allow the group project-based testing methodology to be utilized. Now, does that mean that you cannot test, in particular, cash disbursements on a group project basis? Now, this is a example cash disbursement detail from somewhere. It's not that relevant. I mean, all the payments are here. And you can look and see that when I split this up into a matrix, the projects running across the top, you know, there are 21 projects here. Okay? And the projects are all running through one centralized cash disbursements sample. And that check right here went to all those projects. Whatever that check was for, it went to all of them. Now, some of them are very specific. So here's probably 1 month's worth of check runs for this project. Okay? And the next month, and the next month. And this is for the month of July, by the way. Does this mean, this prohibition mean that on this client with 21 projects, I have to do 25 or 21 separate samples of cash disbursements? Now, under the HUD Audit Guide, we know the answer to that is yes. Because it says, for audits performed under this chapter, the required compliance testing must be done on each project on an individual basis, except when the project is owned or managed, and these following criteria apply. RD does not say anything like that. They just simply say you cannot use the group project-based method of testing. So you are left with two implications where inferences you can draw from that. Number one, it's like HUD and everybody has to have their own cash disbursements test. It's not said anywhere, not even in their most recent Q&A. The other option is you take them at their face value and it says you could do other types of group project-based testing, but not the HUD one. And why would we think that could matter? Well, because under group project-based testing, we're not going to make a sample of all the disbursements in the projects. We're not going to sample from everybody. We're going to go down and sample everything from project number 10. So I would go, hey, look, let's get rid of that, and I'm going to sample number 10. Okay, so there's the disbursements for number 10 for the month of July. And most of these came off one check. Good share of these came off one check. So I'm looking at this down and I'm probably on how many unique transactions? Oh, see, 2570s, one check. I'm probably having less than 20 checks total per month times 12. So I'll be under 240. So does that mean I will pick my sample only from 10, and then I will pick my sample only from number 21. Whoops. And I'll sample from 4 of them. In this case, it would be 4, maybe 5 in 1 year because it's 21 projects. The minimum is 4. So I'm ignoring the disbursements in all the other category or all the other projects. And I'm only sampling those projects' disbursements. That's what that would mean. Or does it really mean that I can just simply go pick, because I don't want to exclude all the projects, I'm going to pick one big master sample from all the projects. Now look, if I have 21 projects times a sample of, let's assume they're all going to be 25. So that would be 525 disbursements I'm going to sample. Okay? For those 21 projects. Now if I did it another way and I picked 60 transactions, that is, you know, a lot fewer. That's 1/4. That's 25% of the other transactions. Well, it's more than that actually. It's probably about 20% of the transactions. I could even go to 120 transactions and pick it from all, make sure sample coverage is from all projects. Now, absent any other guidance, what does the AI CPA tell us about this? Multiple organizational units. Auditors may have additional sampling consideration when the audit has operations in multiple organizational units. If controls over compliance vary significantly, it might be necessary for each location to be considered a separate population. We don't have that. We know there's one cash disbursement thing. And you could then go and test a minimum sample at each location, or you can vary the selection of less significant units from year to year. I have opportunities for doing that. The only place I cannot is in the HUD audit guide because it specifically tells me exactly what has to happen. I have to test cash disbursements project by project. And all RD says is you cannot do it HUD's way. It doesn't say I can't do it another way. Now I hope that makes some sense to everybody. I know that's a little bit challenging from an RD perspective, but if I'm in RD, I'm going to make that argument, and I'm going to quote the AI CPA on paragraphs 21, 44, and 45. I'm going to indicate that there is no specific prohibition against other sampling methodologies, nor does the RD guide say everything has to be tested project by project. It just says I can't use group project-based sampling. Now, some of this is probably down near necessary because of pricing already on a group thing like that. I know that the client who brought this, or the auditor who brought this to me, is looking at a pricing methodology settled on several years ago, and 525 disbursements, 25 on every project, is going to be a difficult conversation to achieve. But for HUD, it is there. And so everybody knows in HUD you cannot do that. But in RD, they left the window open for other avenues available to you. Okay, now, there was another question that came up to me in my email this morning that I was going to get here. Oh, I'm getting right to it. Okay. Let's get down into here. Now, you have this idea of what the guide is used for. So practitioners with nonprofit projects who participate in multifamily programs audit in accordance with the single audit. Well, it's now UG, right? We know that. This chapter is not intended to be a program-specific audit guide for compliance with A133 requirements. However, if the compliance supplement includes a program that is being audited, then it's to be used. If the supplement does not include a program, then you go to Part 7, and there is this guidance. This guide should be used for that purpose. So as far as auditing nonprofit material, the audit guide is covering anything that doesn't have a compliance supplement. Now, there was a question that was brought up about a nonprofit client, 220-unit housing facilities. Each facility has a HAP contract. Both of the housing units are set up as single-member LLCs. Now, the question here is, what happens on these two entities if they each have their own TIN number. Okay, and I will, for the person who sent this in, I will answer separately, but if I will answer the email directly. But I thought it was a good question. This whole question, so the question is, what happens on the CFA? We had the overall client, the entity has a single audit. And both these two projects are listed as, they say, single entity, single member LLCs. What they're probably saying to me is they share the number, or the TIN number of the main member. If they share the TIN number of that, then they're under the single audit of that entity. And you would roll both of those up as the same thing. And HUD would allow you then to file under the Single Audit Act. You would probably end up with one audit being submitted if they're over the limit. So then it said, would the HAP contract amounts be received as federal expenditures on the CFA? Well, that depends if they're the same TIN number. Now, if they're not the same TIN number as the overall entity, then they're probably going to need their own audit in REAC. And then they would be considered separately. But if they're under one TIN number, you get the option to do them together. But the full CFA amount would include both contracts. Okay? And then they would have a full financial submission for those entities. Those two projects would be submitted, and you would have to do a set of supplemental data or REAC schedules for each one of those individual project IDs. But the overall audit numbers could go into the regular audit. Okay. If you're not chosen as a major program, you would not need to test compliance on those. But to the extent they're given in there, whatever is required, or in fact, I'll respond to you directly that there might be a little more information that we need here. Okay, but the guide is used for that purpose. Now, let's go down to this and just get into a couple of decisions. I am going to do this differently. I am going to go to the HUD audit guide, and I haven't put this on my website. What we have done is we have put an audit program together. And we're going to look at the procedures as listed in the HUD audit guide. Now, what I have done is there are procedures in here that you would find they're not HUD. So the ones that are in red are the HUD audit guide. Now I have other procedures for the financial statements, and I have some for UG Capital Advance and UG Section 8. So we can make a program for any of the entities we're dealing with here. However, I'm focusing only on the audit guide. And I think these are just being shown in order of how they came out. And that other would include a couple of other things here. But let's just start off with the list here that's cash receipts. Okay, so that tells me I'm in cash receipts. What I wanted to highlight is here's the first procedure: obtain a basic understanding of the agent's procedures. That list of procedures should include the controls. Brandon, the one you're looking at right now, the master list, is not in that document. I'm deciding whether I should post this or not. In fact, I'll tell you what I'm going to do. I'll post just this one tab of the HUD audit guide in here. And it's not in your materials at the moment. Okay? Now, the point behind all this that I'm trying to show is that these procedures correlate to multiple levels of things. So obtaining an understanding, that is a risk assessment procedure. Yes, it comes from the HUD audit guide, but it is a risk assessment procedure, and it also pertains to internal control. It should list our procedures, and those procedures should highlight the controls. Now, determining whether our procedures for receiving funds in the regular operating account are in compliance with the regulatory agreement and Chapter 2 of HUD 4370.2. That, once again, is a control issue. If you're looking at 4370.2, and we do this in our world, in the material that's already in your material. I think we have here a document 4C. And I haven't found a way to correlate this. When you go down into our, this is the HUD audit guide. And we've embedded other procedures in here. So let me go to cash receipts. Okay, so here was the procedure we were looking at, and it's really hard to split the screen here, I guess. Oh, come on. So it said make sure things are in compliance with, that's not going to work. It's just too small. Well, let's not make my life difficult, huh? It won't get bigger now. Something in Adobe is not happy. Well, when you get down here and it's frozen solid, just when you want to use something and have it not lock up, it locks up. Let me reopen it. This is 4C. So if you're looking for this, it's in 4C in the materials. And I'm going to make this easier for you. To this. Oh, it says my internet connection is unstable. Yeah, I just upgraded to the best stupid fiber optic thing I can have in my office, and that keeps telling me I'm unstable. Now I'm just complaining. Okay. So when you're asking about the procedures in 4370.2, we come down and we will give you the procedures in 4370.2. It might be above. So here are the controls for 4370.2. That tells us what the regular operating account has to have, what the cash management controls should be, numbered receipts, segregation of duties here, disbursements, invoiced, payroll, unissued checks, collections are done here, deposited on the day as much as possible, bank statements reconciled. Okay, those are the controls. So the HUD audit guide is listing this for us and telling us what to do. And so that is a risk assessment procedure, it's internal control, and they're actually listing those controls out for us. Now the name, the project or the cash account is exclusively in the name of the project. That is a risk assessment. It's also a control. And I'm going to just put here internal control on the side. It also covers assertions. Now what the control is having everybody require a separate account so that you can't commingle cash, makes this a control. RD does exactly the same thing. You have to have every project has to have its own account. In fact, every project has at least 3 accounts: operating account, security deposit account, reserve for replacement account. Both are the same. The requirement for all 3 accounts is a control, and it helps to stop the commingling of cash in the wrong buckets. Then it told us to go pick a sample. Now, if we're going to go sample, that was a further audit procedure. Then you had another procedure here about considering understatement or an overstatement of revenue due to fraud risk or move in and move out. That would, to me, that's probably a further out procedure due to high risk. So my risk has already told me what our vacancy loss is and our bad debt loss, okay? And we would be out looking for that. Sorry, we're off the wrong one here. Is this one? They keep changing on us. That would be a further audit procedure. When you go to disbursements, centralized account again, no. And so further, that would be further audit procedure, just for compliance. That was compliance again, tenant. So we've broken up the HUD audit guide into each of these steps to say some of these are risk assessment, some are internal control, and they're covering your assertions. Because you do this in the HUD audit guide doesn't mean that this is not covering an assertion. That is our cash account. It's in the name of our project. That tells us its existence or occurrence. That is my project. So the goal is to split the HUD audit guide down into its component pieces and then have it tell us which ones were risk assessment, which ones were further audit procedures. Then we take credit for that in the risk assessment, and we don't have to add that many more procedures to this. If I went back to just add the financial statement procedures here, these would be, some of these would be risk assessment, okay? And they're not coming from the HUD audit guide. This one doesn't come from the HUD audit guide, but it's a control procedure. It's basic. And it also does the assertions. And so what other, our goal was to look at the HUD audit guide and then determine what procedures in addition to that did I have to do. Now, of course, we could get down into higher risk areas and pick up more procedures. And most of these procedures come straight from PPC, and they give you the risk. So if you're showing additional risk in existence or occurrence or rights and obligations, and that would be a higher risk, this procedure is in response to that risk, and you can show the linkage by those efforts. Michelle, when Brandon's question is there about the Q&A, what he's really going to want is I'm going to take this tab out of the spreadsheet I'm showing, and I'm going to just let them have, I'm going to put this down as a spreadsheet into the materials. So you can take master list of audit procedures, delete all this other, well, I don't even care if you delete it right now. All we've done is broken it up into the audit areas for us. And to show, if you look at AR revenue, so all these procedures were coming out of here were possibilities. Some are for high, some are for low, some are compliance for that. And that's all we're trying to do here is split the audit guide. Oh, sorry, I didn't even mean to close that. All we're trying to ask or to do is to say, look, take the audit guide and look at it in comparison to these other procedures. Tell us which one of these are, now this is tenant files, obviously, so some of these are this would be risk assessment. Here, I can tell you, I've got to go back and look at a few of these. So that would be risk, look at how these go. Okay, so if I were to change each of these and put a cell color of green whenever there was risk assessment, these two would be risk. Everything else here would probably be basic. I would be picking up some more of these in fair housing. So if I went up to fair housing, it would be in other. So I'd have to be looking for other. Tenant. Let me just see what's in tenant alone. We're just getting this out for a tool. Oh, we might have eliminated kind of fair housing out of that because we were looking at fair housing at the time going away, and it's not going to go away. So I might have to come back and find that and put it back in. But if I'm just into the HUD one, the goal would simply be to take your audit program steps, sort it out, list which ones are risk assessment, and see this again, get our HAP contract. That's risk. Applicants come off the wait list, we're sampling, that's a further audit procedure, and it's basic. So anything that's risk would be risk. That was our fair housing, that's risk. That would be risk. I could do that as risk. And that would be risk assessment here. I don't know why this one's not highlighted. It's supposed to be red. So anything that was marked there, we're going to do risk. And then the rest, see, it's very easy to get to the rest of this. And most of the controls are embedded in here too. Now, we talked about controls and how we really want to look at, the control issue. When I look at control, remember this, we're not trying to get stuck on control activities. Oh, I'm trying to just get to one thing here. Unfortunately, all I see is my list for another entity. Show and tell. Hang on. Tools. The reason we want to talk about the controls is I want to make sure we have this list for you. Now, we're going to talk about controls that are not control activities. Remember, PPC does list two types of controls. There's this COSO stuff, and then there are the control activities. A code of conduct or ethics policy exists. That should be a control that applies. I don't know about, I assume ownership is appropriate and they're involved enough to address issues. Management employees are made familiar with the policies. Management acts to remove incentives. I'm going to leave that one. I'll take that one. I don't know about that. Do they set realistic targets? These are all controls. And these are things that are easy to test. Now, one of the problems coming out of this, let's go down to, say, mortgage. What we had recently was somebody came out and said, well, tell me what the control is to pay your mortgage on time. And the client was not having it automatically deducted. And they said, well, how do you test that? and the person asked the peer reviewer, well, how do you determine you pay your mortgage on time? Because that's not relevant. And so the question came down to what would we include there? And they were really pushing hard. And I said, look, go back to your list and find out what things cover mortgage. So let's say I got down to debt. I'm going to mark that column. What would be the controls that would help me get past that? Because he's beating them up pretty hard on this. Okay, so I found some controls. Row 119. And most of this we can do so easily, it's kind of funny. Debt and capital assets are reviewed for appropriate classification, compliance calculations if I have any, financial commitments require approval for senior management, leases are reviewed for capital reconciliation of outstanding debt instruments to general ledger is prepared timely. Well, that one alone could be it right there. Okay? And that's all they were pushing on. So we're really so close to being able to get all this done efficiently that I think the HUD audit guide is the best way to look at this. And when I go to say debt, let me go down to my debt. Let's look at what the audit guide says. Obtain a copy of the mortgage note, risk assessment, right? Obtaining understanding of our procedures, risk assessment. Obtain or prepare a schedule. So if I'm doing number 1, that is risk assessment. And if I'm doing number 2, see, they need to be split apart. But if I'm doing number 2, that's a further audit procedure. But number 1, the schedule would be risk assessment. And then I could go ahead and confirm, or I could add the other procedures based on what's going on, accuracy, averages, comparing terms, recompute interest. Those were other procedures that could have been done. So this audit guide can really do 80% of your audit for you right now, but just by highlighting this material appropriately and taking credit for it at planning. So risk assessment procedures, all but, I can't really separate that cell. So one was a further audit procedure, one was a risk assessment procedure. And the HUD audit guide didn't really care. And then you backfill how many other things you need to do to get your financial statements done. So this is the challenge that the HUD audit guide is presenting for us. And I would say it's the solution to the challenges being presented by peer review. Okay? If we go through the HUD audit guide appropriately and you look at it, what's really happening, half of the procedures in the audit guide are risk assessment procedures. And what are the further audit procedures? Well, the tenant file test, the cash disbursements test, cash receipts. I still think cash receipts is done much, much easier. When you look at this calculation here, we went out and this was another bunch of RD projects, how quick we were able to determine, their rent potential. And the fact that this works this way is so awesome that it's really hard to make it happen another way. You can't be missing cash receipts, and all we're doing is testing that again. And this one did come out, by the way, I think I had it down to $400. I just didn't save it. So I went down to say, all the cash is transferred into one account back to this normal account. So the transfers were $58,000. Where'd the rest of the money go? Well, we left it in our other bank account. And so by the time we looked at each of those deposits, we were only out $700 or something like that total in 15 minutes of time. So I sampled it. I went back to the general ledger and I said the other cash accounts, how many deposits I took out of that. So all the deposits that came in, That was how much? Transferred out. So I think the net of those. So I put most of the money in. But we ended up, if you go, I have to relook at this again, how I did it. But my point is that you can get through most of this with analytical review and be very good on risk assessment. Now, I have one last comment to make between HUD and RD. And I think this is a very big, important thing. We're looking at overall financial statement risks, and I have consistently held that equity skimming is one of those risks. When you do that, there is a difference between HUD and RD, and I think it's important to recognize this, and I didn't pay attention to it until just this last few months. The trend among HUD projects is to give people more and more access to their distributions. Most nonprofits now, once they've refinanced into a insured mortgage, virtually none of them have residual receipt requirements. And so there's a very basic difference between HUD and RD here about fraud. HUD gives their owners access to virtually all distributions of surplus, up to their surplus cash amount. RD doesn't. RD limits them. No matter how much surplus cash you get, you can only get your max amount out. So you're the lesser of surplus cash or the note amount. What's the allowed amount in the note agreement? That increases the risk of equity skimming to be really more significant in RD than it is in HUD, because the owner, what's the motivation in the owner to take out money inappropriately from the project? There's only so much money, so the only play they have is a tax advantage. Because if you take personal expenses and write them off in the project, all you did was reduce your surplus cash. Now, of course, you might not have had any surplus cash, so that's a problem. But in general, the theory being is HUD reduces risk of equity skimming by giving owners access to full distributions. RD will not ever do that because it's really counterintuitive to their program. So equity skimming, and by the way, when you want to have a conversation with fraud, and we're only talking about that, all you have to do is go into equity skimming in the HUD audit guide. Now, we've listed a lot of things here, but if you want to have a good list of fraud discussion for multifamily risk assessment, all you have to do is review Appendix B. Where are you likely to see the problems? Both disbursements, including identity of interests, and income side. If you will address those issues and then follow up on risk, so that how you would do your risk assessment from this, you will have covered almost all fraudulent activities that you can think of if you audit to that. So have a conversation that includes Appendix B of the HUD audit guide for equity skimming. And then just say, how do we adjust our procedures for that? This whole thing, there are no procedures, so that's fine, but this whole thing would be risk assessment. Once you have this conversation, you would have done everything for risk assessment related to fraud that you could really deal with. And I think that's extremely important to know. So the HUD audit guide does most of our risk assessment planning for us. Then it gives us our further audit procedures. It gives us most of our internal control work. And all we have to do is look at it and decide how that testing is going to occur. Okay, now I'm over time. This is our 200-minute time. And internal control, or not the internal, the HUD audit guide spreadsheet with the procedures in it, I will have that posted here in the next 20 minutes. I'm just going to make a review of the remaining procedures to make sure I'm happy with those that are listed as risk assessment. And I will post that down. But it really does handle most of our planning. It highlights most of our controls. Now, you might have to pick up other controls. I'm not saying there are not a requirement to look at other controls, but that spreadsheet is available here already. And anytime you pick the fewest number of controls needed, and most of these will not be sample type items. And remember, there are non-control activity controls always available to us. There are two separate lists, so one would be control activities, the other would not, but they're all controls listed by best practices groups. Okay, I'm over time, but our 100 minutes is up, but I don't have any more questions. So Brandon, yes, you do have to, the last one I had to answer was separating those out in a cash disbursement sample. A lot just depends on the client, which ones will be controls. I don't have any other comments in the Q&A. We're out of time, so we've got our 400 minutes in here without the Kahoot. I'm sorry I didn't give away more money. I apologize for that. This is just tough to get through the last few things here. But I guess, Michelle, anything else you want to say to anybody to close this off?
Just thank you for your participation. And if you attended in a group, please send a copy of your group attendance tracking sheet as soon as you can to Kathy at ahacpa.org. And CPE certificates will be emailed to you within a week.
Okay. Well, I hope to see people in person next year. Have a great week and a wonderful rest of the day. You know how to reach me, Les at ahacpa.org. And I have one question that somebody sent in that I will respond to in the email directly. I try to address it obliquely, but I will address your question in the email. Have a great afternoon.